Stocks. A stock represents partial ownership of a company. When you purchase a stock, you're buying a piece or a share of a company. By owning a share, you own a small fraction of the company's assets and have a claim on its future earnings. There are two ways you can make money by investing in stock. The first is through stock appreciation, when a stock you own goes up in value. If an investor bought the stock at one price and the price went up, the investor could then make money by selling the stock to another investor at the higher price. The second way is through a dividend. This is a periodic payment issued by some stocks. A dividend is a way for a company to give a portion of its earnings to shareholders. Here's an example of how stocks work. Suppose there's a company called Bull Flag Cycling. This company makes bikes, really good bikes. The bikes are so good, in fact, the company wants to expand, so it can sell more bikes to people all around the world. To do this, the company needs to raise money, also known as capital. There are a few ways this company could do this. It could take out a loan, but that would mean taking on a significant amount of debt. Or it could issue shares of stock. By issuing stock, which is called going public, the company can raise money without going into debt. Instead, it sells shares of ownership and a claim on future earnings to investors. So let's meet a typical investor. Our investor is someone who has a little extra cash. He's looking for an investment that has the potential to offer better returns than a savings account, and he is willing to accept the higher risks of investing in a stock. He thinks Bull Flag Cycling is a promising company that's likely to grow. Because of this, he thinks buying a share would be a good investment. So how much does a share cost? Suppose the company decides to raise $1 million, and it decides to issue 1,000 shares of stock. Because each share represents a fraction of the company's worth, and there are 1,000 shares, each share represents 1/1000th of Bull Flag Cycling. Because the company is raising $1 million at the initial public offering, or IPO, each share would be initially valued at $1,000. Let's suppose the price doesn't change after the IPO, so our investor purchases a single share on the open market through his online stockbroker for $1,000. Now, let's see what could happen to his investment. If the company does well and profits increase, the value of the company is likely to go up. As a result, the stock price may increase as well. Assuming the price of the stock goes up, our investor could now turn a profit by selling his shares to another investor in the stock market. However, if the company's ventures don't go as planned, its value could decrease, and so could the stock price. If this happens, our investor could lose money if he decides to sell at the current price. When it comes to investing in the stock market, the basic goal is to buy when prices are low and sell when prices are high. But stocks in the stock market don't always go up. Sometimes they stay the same, and sometimes they go down. And sometimes prices change quickly. Because of this, stocks are considered riskier than other historically safer investments such as bonds or CDs. However, investors keep coming back to the stock market. Why? Because with this increased risk comes the potential for greater returns. Savvy investors take precautions to try to minimize risk, like creating an investing plan, adding diversity to their portfolios by investing in a variety of companies, putting money in other investments besides stocks, and learning trading strategies for up, down, and sideways markets.
Number of single stocks that I own, I don't invest in single stocks. The number of single stocks that I own is 0. It's too much risk. Although the mutual funds have stocks in them, there's 90 to 200 different ones, and so your risk is spread out. In the financial world, we call that diversified. You're not got all your money in one thing, because when you put your money in one single company, you are taking an inordinate amount of risk. So Wall Street Journal has an interesting article, and it's a very long article. You might want to look it up if you're interested in this subject. But it's a very sad story of exactly why I tell people not to do this. Here's the story. Gary Zabrowski started working for General Electric in 1976 at an aviation factory in his hometown of Lynn, Massachusetts. The job paid well, came with benefits, and for Mr. Zabrowski, provided a career ladder for a man with a high school education who started out cleaning toilets. You had a job for life if you get in there, said Mr. Zabrowski, 61 years old. He rose to punch press operator and retired in 2016 after working 40 years at the century-old plant. He left GE with an annual pension of $85,000. Wow. And company stock valued at more than $280,000. Retirement looked pretty good until GE shares collapsed. All of his $280,000 was in General Electric stock, by the way. His shares are now worth about $110,000, prompting a late life job hunt. I never planned on retiring and having to go back to work, said Mr. Zebrowski, who has a monthly mortgage payment and supports a partially disabled wife. It's kind of scary. The rapid unraveling of GE has wiped out roughly $140 billion in stock market wealth in the past year. The industrial giant is one of the most widely held U.S. stocks. Longer term, GE's market cap has fallen more than $460 billion since its 2000 peak. So what is the problem here? Number one problem is that he had all of his retirement nest egg in one single stock. And nowhere in the process did he learn, being the owner of almost $300,000, that was a bad idea. Had that been diversified, I own mutual funds that own General Electric, and their value was affected in a negative way by the fact that that General Electric stock is in there, but it didn't affect me by half. It affected me a tiny, tiny bit, and the other stocks in the mutual funds went up more than General Electric went down, and so actually the net effect was that my mutual funds made money even though they owned General Electric. That's the power of diversification. Spreading out your investments lowers your risk. He basically went to the racetrack and took $280,000 and placed a bet on one horse. That's what this is. That's what you do when you play single stocks. You're asking for trouble. Well, my broker, I don't want to hear about your broker. And I don't want to hear about you bragging on the golf course on your fishing story either. Because that's what stock trading is. It's fishing stories. The one time it went up, for the 16 times you lost your butt. Because it's too much risk. And it's certainly too much risk for Mr. Zebrowski.